Hi there, and welcome to this edition of On Track. I'm Rob McGregor, and this is being recorded on the 31st of August. So we've got performance numbers up to the end of July and economic and market commentary right up to the minute. Let's launch in. But firstly, as always, just a warning, this is designed for clients of McGregor Wealth Management, and particularly those that use our care investment methodology and process. Everyone else is welcome to listen, but please seek out advice to make sure anything I talk about is suitable to your own circumstances. I'm going to cover latest economic news, although it's always interesting that the news goes quiet when there's not a lot of bad news. So as much as the 2 months ago, there was lots of bad news and the media was banging on, they're distracted now by other things, politics, etc. Which is a good thing as the market gently creeps back up. I'll talk about the updates for the market, the portfolio returns, but in summary, July's returns pretty much wiped out the loss of last year. So it's kind of back to a year ago, which is not so bad. I'm going to talk about what's happening with property prices and where fixed rates are up and whether to fix or not. And as usual, try and put it all into perspective. So let's have a look at the highlights of the news and some of the key numbers. Share market's coming back. I'll talk more about that. The short-term cash rates have risen. We've seen the cash rate in this table now go up to very quickly from 0.85, originally 0.35, 1.35, 1.85. There'll probably be another rise. Whether it's going to be 0.5% or 0.25, we'll see what data the Reserve Bank is looking at. I don't think rates are going to go as high as people were fearing. I'll talk more about that as well. 9-day bank bill rates at about 2.3, 10-year government bond yields about 3.5. So they're starting to normalise in that mid-threes. Aussie dollar's been fairly steady, even though it's up and down a little bit around that 69 cents. We're waiting. In Australia, we only do our inflation numbers once a quarter, so we won't get the next update till for the end of September. It looks like all the lead indicators into inflation are still falling. So we believe that will run its course. It's just a matter of how long. US inflation headline number came down a little. Same thing. It should, because the inflation, by the time they report it, as I mentioned last month, it's a lag indicator. So it comes out, tells you what has happened, not what's going to happen. Whereas when you look at some of the leading indicators of what's happening with commodity prices, other prices right to the minute, it looks like that the pressures that we're on for inflation, we're seeing lower oil prices, etc. It's translated a little bit into the pump, but there's always a lag on these things. Mortgage rates, the lowest variables around 3.1%, not too bad really, and not up that much. There's a lot of competition in the space and there's a lot of traps. I'll talk about that more a bit later. So the Macquarie's variable rate, the best rate for people with less than 60% LVR is about 3.69, and you can get 3.55 on a 1-year term deposit. Which is interesting. It's about the same as a government bond yield. How long that lasts, we will see. On the left here, one of my diagrams, you'll see fixed rates, the cash rate down the bottom left, which is now above where it was in the lead up to COVID, but we're certainly returning to that pre-COVID levels. We're seeing fixed rates come back to pre-COVID levels, and about that. And that's interesting because that's kind of where we thought it would all end up, that interest rates end up back at pre-COVID levels. As I talk through this, the main theme of today is we're kind of back to that situation. And then we've just got reasonable but not great growth. And I'll talk through some of these numbers. And let's have a look at the globe. And I know some of you might want to go through all this, but the key I want to highlight here is inflation still high. When you look down this column of inflation, and when I say high, for most of the developed world, it's still single digits. And we expect that to start to fall. The trillion dollar question is, how long does that take? And how does that flow through into interest rates? So we can see interest rates on the rise. You wouldn't want to be in Brazil where they've got the 13.5% cash rate, crazy place. But then if you look at GDP, we've seen slowdowns definitely in China. China's got challenges around their property market, around continued lockdowns, probably due to ineffective vaccines. Yeah, it's interesting to speculate on how long that will last, and it will be interesting to see. China's got an election coming up, an internal election. We won't hear much about the detail, but that's in November as well, same time as the US election. But what I put down in the bottom right-hand corner is just some World Bank estimates on where growth goes. And if you look to 23, 24, the right two columns, you see good growth on emerging markets. That used to be solely driven by China, but will be driven by other emerging economies like Brazil, like Korea, like Taiwan. And the Euro area, not too bad, but tepid. But overall in the world, about 3% growth. So pretty boring, but certainly gives you room for the share market to grow. There's an old rule of thumb that some people use. None of these rules of thumb are perfect, but the share market grows by, the share market returns are roughly about the dividend yield of the stock market plus economic growth, which drives profit growth. So if you put a 4 to 5% dividend in Australia, add growth of 3%, you're kind of in that 7 to 8% range. Let's call it 6 to 8 as the reasonable range of returns. Some other good news in this: unemployment is incredibly low. So whatever Australia cops in the next few years, we're starting with a very low unemployment rate. But debt around the world is high. The US has a government debt of 17% of the GDP. Australia's lower in terms of the debt to GDP sort of ratios. Debt to GDP 137% for the US. Australia only 25%. So we're probably the healthiest debt levels out of all the OECD. So Australia's in a fairly good place, fairly comfortable with our economy. Here's the returns, and I'll highlight there the 1 month returns. You'll see the high growth up 5%, which pretty much matches out the down of the previous year. Still not great, but we all know that the dips in the share market are the price we pay for the long-term returns. So when we look down the 7-year returns, they're still quite respectable, and you should be careful about measuring in the dip. What we always look to do is measure as the market's recovered, but these targets that we use for your planning are still very much, we believe, long-term realistic, and coming through in the portfolio numbers in the longer term. And we'll see where this year goes, but it's looking like a recovery year. I just want to touch briefly, and I've got a funny story to go with this, the behavior gap, which I've talked about. So it's the difference in returns that investors get compared to the returns their investments get. And the reason it's different is because investors, that's us, do stuff. We don't just buy it and go to sleep like Rip Van Winkle in the bottom corner there. We actually panic here, get out there, change to something that's performing hot, etc. Now, Dalbar has been a research house. It's been measuring this stuff for nearly 40 years now. So and the 30 years of the research here shows this point quite precisely. The average equity fund investor over the last 30 years has got a 7.13% return, whereas the market was a 10.65% return. So if someone just stayed in the market, didn't buy, didn't sell, didn't panic, didn't trade, didn't get fancy, didn't try and do anything smart, they got a 10.65% return, which would have taken 100,000 into $2 million as opposed to 789,000. So these behavioral things are critically important. And this is why we talk about it so much, because if you avoid the big mistakes, you win. And the story, we've got a client, we helped them back in 2014. Their aging parents were going into aged care, and we're just helping them with a bit of information to clean up their world. But they put there was an amount in an Australian share fund, just an old school managed fund. It was actually a colonial first state fund, which was, they were popular in the 80s and 90s, and there was 50 grand in that fund. And somehow in the cleanup, it got missed. And then, my client rang me a couple of weeks ago and said, "Oh, there's something showing up on this thing that looks like there's still some income coming from that." It was to do with the tax system. And anyway, we tracked it down. We did some research, found out the fund was never closed. It's just been sitting there for 8 years untouched, and that fund is now 100,000. So while we've had all the dramas of the last 8 years, COVID, everything else, that fund, if you're Rip Van Winkle and fell asleep, the fund just doubled from 50 to 100,000. So another good reminder of the value of long-term investing and not doing what the masses do, which is reflected here. I've beefed this up a little bit. I'll probably use this as a regular reminder. These downturns, so we're seeing the upturn, we're coming back. We're back to where we were, say, a year ago now. But these downturns are common. And the common thing amongst them is this fear of what might happen, fear of tightening, fear of interest rates going up, fear of falling oil prices, fear of rising price, etc. They're normal, they're unavoidable, they're unpredictable, and they're just part and parcel of having shares as part of your investment. And the only logical reaction is to continue with the strategy, buy more if you've got ammunition to do that, but certainly never sell. And certainly that's why the reserves in our process is so important. Talked about that. I won't bang on. I'll get down to some of the more important things. I do want to talk about the media briefly. 3 months ago, when the market was heading straight down, the media was so negative. They were enjoying the fact they could scare us on inflation, rising interest rates, and all these other potential catastrophes, because they've lost our interest on COVID, and as much as there's still not nice stuff happening, people dying, etc. The masses, and that's most of us, have lost interest in being updated regularly. So the media has lost their focal point that they had for 2 years, which they've never had before, certainly not in my lifetime. And now we're watching them jump at all sorts of different things. And it's always the theme. It's like that chart I just showed you. It's a fear of inflation, fear of interest rates going up. It's not things actually happening. It's all about fear. And they're the ones that drive that fear. And when we saw the share market falling, there was headlines every day. Share market plunges, billions wiped off. And as we've climbed back up the stairs, there's not been one headline about the share market steady recovery and the benefits of those that didn't panic and didn't listen to the media. Not one. And this is not surprising. This is what the media does. So just that it's interesting observing the silence on the media on the share market as it climbs gently and recovers, but the noise when it crashes. And always remember, the media's job is to get you scared so you pay attention. And that's why we do this, by the way, is to give more perspective on what's actually happening in the world. I'm not going to dwell on the portfolio structure today. I'm going to talk about, look at this. This is the Aussie share market. So we see in the month of July that bounced back 6%, which almost covered the 1 year down of -7% over the last little bit. We see lots of different returns, the advantages of diversification. Oil prices up, we know that. Wow, luckily, Woodside sits in our portfolio. It's up 80% in the last year. Now, there's obviously things that have gone down by more, particularly the banks, down 12 to 15% over the last 1 year. But this is why we have diversification, because there's always some jewels in there. And once again, a reminder, even though the year looks pretty boring, still down, you've got to add a 5% dividend yield onto that, which actually, which improves that sort of process. When you look at this, and keep in mind this is to the end of August, but 7,500 start, 7,000 finish, there'd be a dividend yield of about 350 at 5%. So pretty neutral for the last 12 months. We're going to see when we do the August performances, I suspect. $10,000, Rip Van Winkle in the market 10 years ago, sitting in an investment in VAS, the ETF that we use for Australian shares, 26,000, a nice result. Let's go to international shares. US shares, up 7.8%, so quite strong. When we look through the different companies in there, across the board, pretty strong in the top 10 companies in the US. Apple 20%, Amazon up 80%. Some good profit numbers coming through there. Same for Tesla. Now, Tesla had been smashed, but up 75% in the last month. So anyone that panicked, got out of Tesla, got out of Amazon at the bottom of that tech cycle, has missed out on an 80% rebound over the last year. Quite staggering. 10-year number, $10,000 to $52,000. So US shares are often the growth engine of the world. That's why we like them in the portfolio. We get exposure to all these companies that we otherwise wouldn't have if we just invest in Australian shares. And also, in the case here, we've had the benefit of a falling dollar over that 10 years, although now quite stable. US small caps, and I should point out, as always, most of these top 10 in the US small caps would be big companies in Australia, but they're relatively small. They've come back nicely as well, rebound 8% in the last month. And once again, really good contributors over the last 10 years. It's interesting when you look at the top 10 here, they're never really companies we know about, but this is the heart and soul of corporate America. So it's not the Amazons and the Apples, but it's just the companies that produce stuff globally that happen to be domiciled in the US. And it's a great part to be invested. You'll see the 10-year returns in this sector at about 15%. We would always expect small caps to outperform large caps by 1 to 3% over the cycle. Global leaders. So this is, once again, those big companies, as well as Amazon, Apple, Microsoft, it's Nestle, Procter & Gamble, JP Morgan, big companies like that, Johnson & Johnson. And you'll see the variety of one-year returns there from, once again, ExxonMobil. And these are companies that you own through your ETFs, up 60%. So nice to know when the oil price is up, part of the portfolio does well. And sorry, the tech stuff still showing over the 1-year return, minus 34, minus 21%, but starting to come back. And as we see, so that the leader's actually down a little bit for that month, but coming back. Emerging markets has been the toughest area to be an investor in the last 5 years. So we've only got a return of 2.8%. It's a relatively modest bit of most portfolios because it is volatile, but it absolutely outperforms in the long run consistently. And we're seeing that's where world growth will be led by. So we see at the top of those holdings there, Taiwan Semiconductor out of Taiwan, Tencent out of China, Samsung out of Korea, Alibaba out of China. And I don't know all of these, but a fair bit of China, and China, Taiwan, South Korea, and not much of the Vietnam, Brazil, and the other areas. But this is only 22% of the portfolio. It's the top 10. Now, it's interesting to note that even though emerging markets hasn't done as well, Rip Van Winkle investing 10 years ago and forgetting about it still would have woken up with roughly double his money over that 10 years. So not so bad. Gold, similar story. Well, not a similar story, actually. Gold's going the opposite of everything else, which is a good sign. When gold's going down, it's a good sign for the rest of the portfolio. So we actually don't mind gold going down. We hold it as a hedge or as a bit of an insurance policy for when markets wobble, because gold tends to get a better return. But gold's down a little bit for the month, flat for the year, not too bad over 3 years. An investment in gold in the exchange traded fund that we used 10 years ago would have taken 10,000 to about 16,000. So not too bad, once again, on the Rip Van Winkle scale, but not as certainly not as powerful as the US shares, etc. So let's talk property. And once again, the media here is talking about, there's lots of headlines about fear of property crash, forecast of property crash, projection of property crash. Leading economist says property is going to go down 25%. Now, we've talked here before about how that track record of those economists is terrible when it comes to actually predicting anything financial. And let's have a look at what's actually happening. So firstly, in rates, and I just want to point out, so these are the fixed rates. You'll see here, the color-coded, the green rate here is the 1-year fixed rate. So the 1-year fixed and then the 2-year fixed, they're all up to very much pre-COVID levels, and they've got really high. But when you look on the right-hand side here at the variable rate, so the variable owner-occupied, P&I is the green rate here, at about 4%. So it's kind of back to where we were pre-COVID. So my starting point for most people at the moment, and I'll explain this, and as I said, please reach out to us for our clients, get advice if you're not a client of ours, is I would definitely avoid fixing rates at the moment. Let me explain why. If you're fixing a 5-year rate at the moment, you're up in the 5-6% mark. So let's say variable rates of 4%. And by the way, you can get better than that across the board. So there's never been a more important time in borrowing in the last 5 years than to do your homework, talk to us. We can put you in touch with people, but you should either be renegotiating, refinancing to make the banks work hard to get the best rate. But let's go back to this fixed or variable. So let's call it variable rate 4 and let's call it fixed rate 6. So for you to be better off by fixing, interest rates would have to go from 4 to 8 over that 5-year period. They would have to average more than 6 over that 5-year period. And we're starting at 4. Now, I know we can get 3.4 or 3.2 was the best rate we can find. So I'd be very loath to fixed rates. There's only one reason to fix rates at the moment, and that is if you absolutely need certainty about your cash flow, but you'd be paying 2 to 3% higher than you would need to be to get that certainty. So therefore, you're better off to use strategy and tactics like pretend the rate 6%, make payments at that level, and that will get you ahead so that if payments actually went up, you've got a buffer. But yeah, certainly I would lean towards variable for 98% of people at the moment. If in doubt, yell out. Let's have a look at what's actually happened to property prices. They're down. This is what they're down in dollar terms since they peaked. We'll talk about here the peak. This data is from CoreLogic, who've got the best data on property. Sydney price is down 60 grand. Sounds like a lot, but the median price of a Sydney property is $1,087,000. So it peaked in January and it's down a whole 60,000 from there. So it's not a lot. And anyone that didn't look at prices for the previous 2 years would be up on where they were 1 year ago, 2 years ago. Melbourne down 27,000. But once again, from its peak of 800 and something, still around 800,000. Not much. Hobart down 12,000. Look at Hobart's price compared to some of the others. But down hardly a thing. Canberra down 10,000. But it's up in the near $1 million averages. Brisbane down a whole $6,000 to 781,000. Adelaide and Perth are still at their peak. They haven't come down at all. Not very scary when I look at that. And it actually tells a success story of those that invested that have enjoyed. If we look back further, we see incredible gains over the last 5 years for nearly all of those places. At the moment, we've also got massively low vacancy rate, which means rents are rock solid and rising. I know that's not a great story for renters, but for investors, it's a good story and helps compensate for some of those higher interest rates. Our friends at Heron Todd White, you'll see the cities that are shaded in orange here are the ones that are actually starting to fall. The biggest one, obviously, Sydney. And then you've got some regional areas or other areas, Brisbane falling a little, starting to decline. Geelong, these are the ones that have moved. But we've gone from a situation I'd never seen before, where the whole of Australia was in a rising market, to a little bit of balancing out there. But look at the pack that's still rising, including the Sunshine Coast, including areas like Toowoomba, Perth, Adelaide. So there's still areas that are going up. This is not what you're seeing in the headlines. It's the theme of today. No newspaper headlines saying property prices still rising in the bulk of Australia. They're focusing on the Sydney story, etc. Same for units. Sydney is the one that's got the biggest decline. But as we said there, that decline is not scary. And for any long-term investor that got in a while ago, they're doing really, really well. That's it, short and sweet this time, and just reinforcing our process as always. All the best investments are best made as part of a real plan. That's where we've got some genuine goals based on you, your life, and what's important to you. Portfolio designed to meet those goals over the long term. We diversify, we do all the boring stuff, the asset allocation, maintain enough liquidity so we never have to sell good assets at a bad time. Low cost as much as we can, but occasionally we'll pay up for some managers where we believe some specific expertise is required. And the way we protect against that short-term volatility is with enough reserves for our retired clients to get through a few years without ever having to sell. Dollar cost averaging for our young clients, that just means buying on a regular basis, particularly on the dips, and rebalance regularly, which gives us good returns. There's only 3 ways to lose money, and as always, don't do them. And congratulations, as always, to our client base, which are wonderful in not ever panicking and selling, not having to sell by planning ahead, and you are massively diversified, as you see from those shares. Thank you as always. Look forward to seeing those of you as you come through reviews in the next few months. And until next month, this is Rob McGregor signing off.